Bismillahirrahmanirrahim. This is the first video on profitability analysis. And in this video, we will explain how to evaluate firm's profitability using earning per share analysis. We will explain how to calculate basic earning per share and how to calculate diluted earning per share with complex capital structure. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with discussing how to calculate earning per share. A firm has a simple capital structure if it does not have convertible bonds or convertible preferred stock that holders can exchange for shares of common stock. Options or warrants that holders can use to acquire common stock. In other words, a simple capital structure means there are no financial instruments like convertible bonds, convertible preferred stock, options, or warrants that can be converted or exercised to obtain common stock. So let us solve an exercise on calculating the basic earning per share. We have the relevant information here, and this is the additional information regarding the retained earning changes, and we will apply this formula for calculating the earning per share. Now, the net income available to common shareholders is the total net income of 7,500, and from this we are going to subtract the preferred stock dividend of 500, and we are going to divide this by the weighted average number of common shares outstanding. Now the common shares outstanding are given as to us as 4,000, and we are assuming that the preferred stock is not convertible to common stock, so we are going to add back to outstanding shares. So 4,000 plus 3,000, and we have to take the average of this, and this will be divided by 2. So the earning per share is equal to 2 per share. Next, let us talk about diluted earning per share with complex capital structure. Now, companies' capital structures is complex. It not only includes common stock but also convertible securities, stock options, or warrants. So they must report two types of earning per share: the basic earning per share we have just now discussed about, and the diluted earning per share. Now, in the basic earning per share, we have seen we calculate the earning per share using the number of shares outstanding without considering any potential dilution for convertible debentures, securities, options, or warrants. Diluted earning per share takes into account the potential dilution that could occur if all convertible securities were converted into common stock, or if all stock options or warrants were exercised. Diluted earning per share is always equal to or less than the basic earning per share because it reflects the potential reduction in earning per share due to these instruments. To compute diluted earning per share, only those securities Options and warrants are included that are exercisable and would reduce earning per share. Any instrument that are not yet exercisable, like unvested options or would increase earning per share upon conversion, are excluded from the diluted earning per share calculation as they are considered out of the money or anti dilutive. So, in summary, diluted earning per share provides a more conservative measure of a company's earnings per share because it considers the potential impact of all potentially dilutive securities, while basic earning per share is a simpler measure that does not account for such potential dilution. This is the formula for calculating the diluted earning per share. So, to calculate the diluted earning per share under both US GAAP and IFRS, adjustments are made to address potential dilution from convertible securities and stock options. So, let us talk about the adjustments in the numerator. Now, the interest expense or convertible bonds is added back net of taxes because it reduces net income attributable to common shareholders. Dividends on convertible preferred stock are added back because they reduce net income available to common shareholders. Compensation expense from employee stock options is not added back to net income. Any amortized compensation expense affects the denominator of diluted earning per share. The denominator is also to be adjusted. The weighted average number of shares outstanding is increased to reflect potential dilution from conversion of convertible bonds, conversion of convertible preferred stock, exercise of stock options, and warrants. For stock options, the calculations assumes the firm would repurchase shares on the open market using cash proceeds from option exercises, unamortized compensation expense related to the options, tax benefits increasing additional paid in capital. So only the net incremental shares issued, options exercised minus shares repurchased are included in diluted earning per share. In essence, diluted earning per share adjustments aim to provide a cautious measure of earning per share by accounting for potential increases in shares outstanding from convertible securities and exercised stock options. Let us solve an exercise on diluted earning per share with complex capital structure. Dawn Corporation has the following capital structure. The preferred stock of Dawn Corporation is convertible into 1000 shares of common stock. Dawn Corporation has stock options outstanding and in the money which holders can currently exchange for 300 incremental shares of common stock. To calculate the diluted earning per share, let us see how we are going to proceed. First of all, we are going to have the same net income of 7,500, and from this we are going to subtract the preferred stock of 500, stock dividend of 500, and we are going to add back the 500 of preferred stock dividend again. So we are going to add back the 500 of the preferred stock dividend to the numerator because converting preferred stock eliminates the need for paying dividend on it. In the denominator, We are going to increase the weighted average number of shares in the denominator. Uh, and this is going to be as follows. We have the same value for the basic earning per share, that is zero point 0.5, 4000 plus 3000 divided by 2. So this will be 4000 plus 3000 times 2 divided by 2, that is times 0.5 plus 1 time 1000 shares of common stock issued upon conversion of preferred stock, and 300 of incremental shares from the exercise of stock options. So, in summary, diluted earning per share calculations account for potential dilution by assuming conversion of convertible preferred stock into common stock at the beginning of the year. So, this will be equal to 1.56. This eliminates preferred dividends and the denominator is adjusted to reflect the additional common shares issued upon conversion from potential stock option exercise. The criticism of earning per share are that earning per share does not consider the capital or assets needed to generate earnings, which can result in varying profitability among firms with the same earning per share. Changes in the number of shares outstanding, which affect earning per share, are primarily influenced by a firm's effort to manage its stock price rather than indicating the capital invested in the company. Changes in earning per share over time can be misleading indicators of profitability because fluctuations in the number of shares outstanding can have a disproportionate impact on earning per share. So, despite these limitations, earning per share remains popular in earnings announcements and for firms' valuation because it is easily comparable to a firm's stock price. Let us solve one more problem on calculating basic and diluted earning per share. TJX Incorporation, an apparel retailer, reported net income amounts in thousands of 609,699 for year 4. The weighted average of the common share outstanding during the year 4 was 488. So weighted average is already given to us. For common shares, TJX Incorporation subtracted interest expense net of tax saving on convertible debt of 4,482. So this is going to be added back. If the convertible debt has been converted into common stock, it would have increased the weighted average common shares outstanding by 16,905. It's again the weighted average. So TJX Incorporation has outstanding stock option that, if exercised, would increase the weighted average of common shares outstanding by 6,935 shares. Compute basic and diluted earning per share for year 4, showing supporting computations. So if we are going to go for the basic earning per share, that is going to be net income available to common shareholders, and the net income available to common shareholders is 609,699 divided by the weighted average number of common shares outstanding, and the weighted number of share average of common share outstanding is 488,809, that is equal to 1.25. Coming to diluted earning per share, this will be equal to net income available to common shareholders, and the net income available was 609 699, and to this we are going to add up the adjustments for dilutive securities, and that was how much? That was 4,482, and this will be divided by the weighted average number of common shares outstanding, that is 488,809, plus the weighted average common shares outstanding uh, of 16,905, plus uh, the weighted average common share outstanding by 6,935, that is the weighted average that is equal to 6,935. So this is equal to 1.2. So this completes the first video on evaluating firms' profitability using earning per share analysis. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah, I will reply you back. Thank you so much and happy learning.